Now, the next session going to be conducted in English by Aiman Shamsul. Now, we actually have our final session of the day. Let's welcome Mr. Aiman Shamsul, the Vice President of Malaysia Association of Technical Analysts, who'll be talking about momentum and building a portfolio from a technical approach. Now, let's over to you.
Thank you so much, Chris. Hi, good afternoon. Let me get my screens on. Well, yeah. Okay. Thank you so much, Chris, for the introduction. Hello, good evening, and thank you so much. And this is the last session that you have for the Singapore Trading Festival. My name is Aiman Shamsul, and today, technically, I'll be covering the last topic for the whole festival that we had for the last 4 days, which is on the momentum investment. And here today, I'm just gonna give you like a rubric or just a one-on-one technique on how do you build a portfolio on your own investments portfolio via a top-down approach. So there's a lot of ways. There's no right and wrong. When we talk about top-down approach, basically how I want to show today is actually using technical analysis purely on the technical point of view. But before we start on technical point of view, it is best if we know and understand further how to build a portfolio, what is the portfolio, and why is it important. And the argument that usually people have is when they look at the technical analysis, they purely look at technical analysis without looking at any fundamentals, any numbers, any news. So I would like to just share with you, based on my own experience, based on my own knowledge, how I build roughly a portfolio in equity investments. So before I start the talk for the next 1 hour, I would like to quote by Mr. Warren Buffett: "Wide diversification is only required when investors do not understand what they are doing." So this is very important because normally some people, when they hold any stocks or any holdings, they hold until like 20 different stocks. It's just because they're not sure where to put their money in. So this is why it is important for us to really understand what's going on in the market, what's the news related today, and what's the macro theme before we even decide to put our money in. And before I further discuss about this topic, I just would like to put a disclaimer that this is purely for educational purposes and should not constitute to any recommendation buy and sell or any, this is a stock for you to buy for the next 1 week or 2 weeks. No, this is purely for educational purposes, and I'm just sharing with you my own knowledge, my own experience on how we can construct a proper portfolio in equity investments. So a little bit about myself. My name is Aiman Shamsul. I'm a certified chartered technician, MSDA and CFTE. At the moment, I'm also a vice president for Malaysian Association of Technical Analysis. And previously, I did a few courses with NUS, and before I become the vice president at Mata. Right now, I also have my own full-time job. But before that, I was actually a head of treasury for the Human Resource Development Fund Malaysia, and also an ex-portfolio manager for Bank Negara. There, actually, I was looking at fixed income, which is bonds, money market, equity, as well as FX. So my last post there was actually with regard to strategic asset allocation, where we decide, for example, for the next 1 year or 2 years, what kind of asset allocation we should hold based on the reserve sizes. And on top of that, we also have our own, P&L. So that's what, this is how basically today, I'm just sharing with you my own experience. And in particular, I'm not talking about fixed income, FX, I'm just going to talk about equity market. Okay, so the objective today, I hope all of you, the participants, by end of the session, you will be able to identify and appreciate, first of all, what is portfolio management and what is the overview of the macro landscape for 2022. I know a lot of speakers already talked about this, so I'm just going to give you an overview again, more like a recap, and then a top-down approach in constructing a portfolio. And then after that, you apply technical analysis, a basic one, to ensure we are in the right direction. And then lastly, you're going to track how you're going to track your portfolio, whether it has performed well or is actually lagging against your benchmark. So the benchmark we are talking today is actually the Straits Times Index. We're not comparing STI against S&P or against NASDAQ. No, we're not. We're just going to focus purely on the local market in Singapore. So what is portfolio management? I did a survey last month in March among all the technical analysts in Malaysia, investors, retail investors. So based on the survey, a lot of people mentioned that portfolio management is purely a fund management. And sometimes they say it's a diversification and it's purely an asset allocation. So pretty much, I think based on survey, a lot of people knows what is portfolio management. And there are also people saying that it's a position sizing, how you size the position according to your portfolio and how you need to restructure or rebalance your stock holdings every single week, every single month, or every single quarters. So when I want to explain what is portfolio management, the screenshot that you have in the screen there, basically it encapsulates, it summarizes in total what is portfolio management. And with regard to the portfolio management, of course, the idea is you want to have a diversification. These photos is pretty normal. A lot of people actually seen this photo before. It's about do not put all of your eggs into one basket. So imagine you have all your stocks, you hold for example, technology stocks in which we know where they are today. Because last year it was good, giving you a good return. So a lot of people buy a lot of technology stocks and they put all their money into one sectors. This is where you have the issue of if you drop your basket, the whole eggs actually drop and smashed. So diversification actually talks about you putting some of your money in other asset classes or sectors. For example, you have commodity sectors, commodity asset class, you have mid caps, you have small caps, or you have bonds. So the idea of diversification is not about you putting all your money everywhere. So for example, you have 1 million you put in every single sectors that you have in the STI index. Nope, it's not about that. It's about this curve. So what is this curve? This is actually an efficient frontier, basically based on theory introduced by Harry Markowitz. I think a lot of people who's taking finance heard his name before. So in 1952, he actually introduced the term efficient frontier, and it's actually a cornerstone of modern portfolio theory. So the efficient frontier here, what does it tell you is, it is basically a scale of y-axis and the x-axis. The y-axis is actually your return. X-axis is your standard deviation. Standard deviation here is actually your risk. So from this graph, you know that as a portfolio manager, even yourself as a retail portfolio manager, or you run a family houses, you want to get returns somewhere at the top of the efficient frontier, where, for example, you have the least, this is the optimal one, you have the least or the lowest risk in your portfolio, and you have the most optimal return. But some of us, we love to pawn the market. We love to, put 100% of our basket at one single darling stocks. They say it's a gem, and it will make you 100 or 200%. Yes, maybe you can have like a very high return, but your risk is getting higher and higher. So if the stocks that you choose is good, you're putting higher risk with a higher return. That's fair. But if you do not know where to put your money, you have higher risk and you have the lowest return. This is the worst case scenario. So for you, invest in the financial market. You want to make sure that you have the most optimal return with the least amount of risk. So if your whole portfolio goes wrong, the risk, the money that you put at risk is pretty much low. Okay, so next, when we talk about portfolio management, there are many ways, there are many approaches with regard to portfolio management. The most popular ones, like our CPF money, or maybe with the unit trust, is more like a passive portfolio management. So what is a passive portfolio management? It is pretty much you put your money, you set, and you forget. most popular instruments under passive portfolio management is the ETF. You have the exchange traded funds, which mirroring the performance of the fund, of the index itself, sorry, not the fund, mirroring the performance of the index. So this is commonly referred to as indexing or index investing. So people will use this basically to make sure that their money that they have, that they invest in, is at least can beat, the usual index performance, or at least can cover the inflationary rate. The one that is more popular among youngsters, I would say, meaning people who love to take higher risks, they have that appetite, is to go for the active portfolio management style, which is, higher alpha. What does alpha means? Alpha is basically you try to beat the market. You try to beat, for example, if the STI index or even S&P 500 up for 20%, you want to get 30 or 35%. The extra return based on the benchmark is actually your alpha. This also involves stock picking, individual sector picking, and usually active managers, what they do under active portfolio management, they've tried to apply a lot of tools, including quantitative tool or even qualitative tool, to aid in their valuation and evaluation of their potential investments. Another two one down here, discretionary and non-discretionary, is pretty much discretionary, where, for example, you have your client gives you the money, all right, and the client just say, I want to have a return on minimum certain X percentage. If you're a discretionary portfolio manager, you have a full flexibility to make decision for the investors. However, if you're non-discretionary, the portfolio manager will act only based on the instruction received from your client. So these are the popular portfolio management ways. And I would like to share, with regard to portfolio management, how does portfolio managers look at the market? Okay, so a typical approach of constructing investment strategy will involve having a macro view, and then after that they will have multiple discussions on what's the best asset allocation, and lastly is the execution. Let me go through and walk through the whole process. So we have clients, we take monies, right? For example, even like if you're managing pension funds, these are all money belongs to your clients. And as a portfolio manager, you have to decide what kind of asset class should I put the money in? Should I choose bonds, equity, or cash, or even alternative investments asset class? For example, you have metals, or you have energy or commodities. So how they decide on this asset allocation? They will look at the market as a whole. What is the view on the market? When you look at the market, you look at the news, you look at what are the factors or the drivers moving the market. So some of them will look at, of course, this is most popular. I look at these factors. We look at the inflationary rate. We look at growth. We look at the interest rates. Because right now, these are the most popular topic, especially for 2022, because the world just recovered from COVID, and right now a lot of countries actually opening up their borders. So we have, company expanding, people starts to book flights to travel for holiday. So over there, it gives a bit of inflationary pressure, higher demand than supply. And because of that, when you have inflationary pressure, of course, the MAS, the Fed, they'll start to do something. They have to contain that inflation because they do not want to have a high inflation environment that will hamper any growth recovery. And then from there, once you have that market view, you'll look at the security selection itself. Talking about bonds, we'll choose what kind of bonds you want to buy. If you want to take credits, for example, you want to take bonds issued by corporates, you have higher returns. Or you want to go and buy bonds issued by the government like US Treasuries 10 years. We have in Malaysia, we have Malaysian government securities, MGS 10 years or 5 years or 2 years. Those are actually security selection for equity. We look at what kind of sectors you want to go in. And from there, you have the valuations, and valuation goes back to your fundamental and as well as your technical. So that process is purely a security selection and other information that you get from the market. Because normally from networking, from chit chat, from seminars, forums, you get a lot of other information from the market. And lastly, once you have your security selection, it goes down to your execution and evaluation of your performance. So when we talk about evaluation of performance, portfolio managers will look at not all, some of them will choose one or two depending on what is their mandate, what is the purpose of the fund. And first of all, most common one, they will look at the market index. Like for retailers, most of the time, majority retailers, they will look at the market index performance. If that particular year, all my stock holdings earning about 10% return, but the market index earns about 5% returns, that's good because you are beating the normal market index, which is similar to how passive portfolio manager conduct or manage their portfolios. If you are more competitive ones, they will compare the performance of one portfolio manager to another portfolio manager. Like for example, if I'm running a fund management, I have my own particular fund, I'll start to compete with my peers who's managing another fund. So these are part of the performance evaluation. The risk-adjusted return, or other people will say it's Sharpe ratio, is purely we looking at how much risk if you invest in that particular asset and how much return you can get out of it. Of course, you have to minus off the risk-free rate. So from there is a risk-adjusted return, because a lot of people actually confused about this, because when they tell their friends, they show their performance, they show that they are getting about 50% or 100% return. But when we look back at the asset class that they chose to invest in, the risk is way much higher. So 100% return doesn't mean you are getting 100% return without risk adjusted. If risk adjusted, that 100% return might go down to even just 20%, because they just readjust that performance against the risk that you're taking. And lastly is the tracking error. So the tracking error is basically reported as a standard deviation percentage difference, or basically just a difference, which reports the difference between the return an investor receives and the benchmark they are attempting to imitate. So tracking error is actually, you're just looking at actual performance between a position or your portfolio and the corresponding benchmark. And you can view it as an indicator on how active a fund is being managed and its corresponding risk level. So that's how people evaluate their performance when managing or when talking about portfolio management. So now, pretty much I give you an overview how portfolio managers manage their portfolio, and you can replicate how other professionals replicate running their portfolio. For retailers, I believe some of our audience also are retailers. You can replicate the same method. So now, once you know what is portfolio management, why is it important? It's just because to manage your risk. Let's look at the market we are in today. So for 2022, the key theme will be three. First will be rising inflation. You have a huge inflationary pressure. You can see from the jobs data, or you can see from the average wage in the US and from most developed country, it has been exponentially higher and higher. So it creates an inflationary pressure because a lot of people actually have the money to actually spend. So you have a rising inflation. And because of that, the central bank throughout the whole world need to step in because they need to contain the inflation. You know that if inflation is very, very high, it will hamper the growth. So we don't want that. So the next theme that we have is, it is a tightening monetary policy. For example, Fed Chief Jerome Powell on March 16, 2022 has announced that the Fed has increased the Fed fund rate by 25 basis points since 2018. And because of that, many economists actually believe that the Fed will increase the rates further to combat inflation, which is multiples of above target of 2%. So rising interest rates normally will lead to higher borrowing costs, which can lead to a slowdown, but not a recession, but it's just a slowdown in global economy or in a local economy, because growth, I mean, basically it's a tool for the Fed to control inflation. Just so because of that, if you have a higher interest rates, inflationary pressure will start to go lower and lower. All right. And we can see based on the last numbers on non-farm payrolls last Friday, it has increased about 431,000 last month after an upward revised 750,000 gain in February. So it shows that somehow the economy is good. A lot of people are actually getting more and more jobs. Although these numbers that I quoted are all based in the US, it basically, it gives you an overall overview how the health of the global economy is actually going to be for the next few weeks or few months. Of course, right now we have a strong debate that the economic recovery after COVID is like a K recovery, whereby you have a very huge divergence between the recovery in the developed market and the recovery against the developing market. Just look at an example of US versus China. Right now, China is still struggling. Hong Kong especially is still struggling with COVID, but other parts of the world, the borders are opening. People just back to normal. And some places like even Singapore on 29th of March has relaxed a lot of rule with regard to wearing the mask outdoor. So that's the second theme. We have the tightening monetary policy. And lastly, you have the growth recovery post-pandemic. So this is the important part, because when there is a growth, you're talking about people consume more, people travel, people buy things, people upgrade their equipments, their gadgets. And because of that, companies can make more money. They can have more sales. So it's just part and parcel of how the economic trend works. It's all about how one factor impacts another factor. And it's just a spiral down effect, whereby if things are good, everything's going to be good in the economy. If one factor is bad, it will trickle down to other parts of the economy. So we have these three factors, these three main themes for 2022. And of course, recently we have war. But again, when you talk about war, it's a geopolitics, you cannot predict that. But what does geopolitics do is it will hamper growth. That's one thing. It will hamper freedom of movement. Sanctions, for example, will hamper movement of goods, services, trade. So it will hamper growth. Inflation as well. This is where we're going to talk about in detail. For example, is it a cost push inflation or a supply cost push inflation or demand push inflation? Is it a supply side or a demand side? Demand comes from your salary, from your job. You have higher salary, you have more demand to get a better goods. But on cost, it's actually on commodity. What we've seen, Ukraine and Russia, it has spiked. It has caused commodity prices to spike to all-time high. You look at nickel, for example. You look at aluminum. It actually, those commodities is building blocks or the fundamental of how the whole economy gonna be going forward. We're talking about electronic sectors, technology. To produce every single chip, you need at least a copper, you need aluminum, nickel. So it has an impact toward these kind of sectors. So that's why you can see for the performance for the tech sectors since early of the year is not what we have seen in 2020 or 2021. It's actually quite disappointing. So this theme is very important as a fundamentalist or a technical analyst for you to know how to move your money. And you have to just look at the theme, and normally the theme will revise every single 6 months or every single year. So you have to check basically what are the markets talking about? You can open up CNA, you can open up Bloomberg or Reuters. They'll talk about the same thing all over again and again. So that's how people pivot their money. So with these three themes, we try to deep dive. For example, before we construct any portfolio, let's see the sectors within SGX. So of course, we have the SGX mainboard, and then we have the catalyst. And then there, we have all this all-share index, fledging, catalyst index, and then you have the mid caps, the small caps, China index or maritime index. And most important part is the sectors within the SGX. So you have the banking, you have food and beverages, you have financial services, industrial goods and services, oil and gas like energy, you have real estate, travel, media, retail, and telco. So from the three main theme that we talked about earlier in the previous slide, the next question is, looking at the macro landscape, which sector benefits the most? That's a key question. After you look at a theme, following that theme, which sector is really going to benefit the most? I'm just going to explain to you one theme, which is rising interest rates from Federal Reserve, from MAS, from even where I'm from Bank Negara, Malaysia. When you talk about a rising interest rates environment, we're talking about economy is recovering, okay? Job creation is there, wage are improving. So what does it mean is the economy is improving because people has more spare cash or disposable income to spend on their daily life. And because of that, when they have more money, more salary every single month, they'll take more borrowing as well because they want to purchase something bigger, something better, something new. So the borrower actually will make more money, and because economy is recovering, they have the ability to make the repayment. So during an interest rates rising environment, who will benefit the most? When talk about money, talking about borrowing, more people can borrow money, right? First sector that will benefit from a rising interest rates environment are financial services sectors. So when talk about financial services, we have banks, you have brokerage house, you have the mutual funds. This is a sector that will benefit the most. Just looking at one theme, which is rising interest rates. The second sector that will benefit is actually because the rising interest rates talk about growth. When talk about growth, people, they spend, they go out, they have leisure, traveling, go for all these activities. They buy food because, you travel, you need to eat, right? So you got buy more food. So I know also you will buy more new goods, new gadgets. So the next sector that will benefit from this theme will be the consumer discretionary, staple food, beverages, things like that. So F&B is one of it. Consumer discretionary is one of the sectors that will benefit from it. And lastly, when talking about gadgets, of course, you have manufacturers. Actually, they will sell more new appliances. So those are the three levels of how a small factor will trickle down into the economy. All right, so just now I mentioned about three sectors. We have consumer, we have banking, we have manufacturing or industrial goods. Okay, so from there, we know which company or which sector we want to put our money in. So this is purely a qualitative assessment. You look at the theme, you look at the macro theme, and you think like which sectors will benefit from it. So let's try to be more objective. Let's apply technical analysis. So before I start on technical analysis, what is technical analysis? It is basically a subset of behavioral finance, and it's purely a study of action and reaction of market participants involved in the financial market. So what happens is actually it emphasizes the reasoning or the psychology behind any financial market movement. So that's why when we talk about technical analysis, it is purely a method used to measure biases in the market, which translated into price patterns, trend, or even levels that can be measured based on its probability it will hit certain prices and which one can give you the most profitable outcome. So that is technical analysis. And there are many tools in the world of technical analysis. There are too many of it. Just like talking about fundamental, you have the discounted cash flow method, you have other peer valuation method, you have industry valuation method, or even just purely PE. So when you talk about technical analysis, you have many, I would say, tools that you can apply. The most basic one, of course, the Dow theory, which is the philosophy of technical analysis, where you're going to learn what is a bullish market, a sideways market, a downward market. And then you have the chart pattern and movement, where you look at the chart prices, you look at the patterns, whether it's a triangle, a bullish breakout, a flag. And then you have the indicators. A lot of the speakers today actually talk about indicators. I mean, at least they use indicators. For example, the most popular one would be MACD. You have the RSI, the stochastics, the moving averages. And then you have the Japanese candlesticks and patterns, like, you know, all these candlesticks pattern that we've seen. And then we have terms like Marubozu, we have terms like dark cloud cover. And next we have the Elliott wave principle. Basically, it's just a predicting method on what is most probable, highly probable outcome based on the price trends. You have the Fibonacci, looking at how prices going to gyrate and hit certain Fibonacci levels, point figure charts, and lastly, Ichimoku trading. So in technical analysis, basically there are two methods. First is trend following. Second one is trend predicting. A lot of technical analysts will rely on one method, which is trend following. A lot of people actually use trend following. Even during our trading festival, a lot of speakers talk about trend following. Another way, the advanced one, or more, or not really advanced, but I mean the more that is those people who prefer to predict what's the next move, they can use trend predicting method like Elliott wave, Fibonacci, point and figure, as well as Ichimoku. Trend following roughly is about, you know, finding what phase the market is, the chart patterns, the indicators. Those are trend following. So using all of these technical indicators, what is it for? Ultimately, you just want to know whether you want to buy or you want to sell the market or the particular stocks. So you look at the overall trend, you look at the support level, you look at the resistance level, you look at the momentum, and then you look at the behavior or the sentiment behind it. Is it a good sentiment? Is it a bad sentiment? How long does the trend has developed? Things like that. So when you use technical analysis to build a portfolio, one method that I would like to emphasize is try to use a top-down filter, meaning you look at all this info, you have all this info from bigger time frames, and you filter it down until you get your final decisions. I'll show you later on using live charts. And for us to look at the trend, I'm going to apply a simple moving average. So it's actually a very popular tool used by people in the financial market, even people at the fund management side. Even they're not a certified chartist, they will use moving average just to gauge on how market moves, whether the trend is actually an uptrend, downtrend, or sideways. Okay, when we use moving average, the way to use it is purely looking at what is the underlying trend. That's the first one. And then what is the signal giving that you see from that trend? Is it a buy or a sell? And lastly, you look at it in terms of where is the support and resistance. All right. So again, when we talk about top-down approach in technical analysis, it's a very easy, it's a simple concept to ensure that we are investing in the right market direction. So first of all, you have to look at the global trend. After you look at global trend, you can see, for example, you look at big indices. You can look at S&P 500, Nasdaq 100. You look at all of these global market indices, and then you look at your own main index that you want to invest in. In our case, we are talking about STI. So that it will be your main index. And from that main index, you drill lower to a lower level into your sector analysis. So what kind of sector you want to invest in. Also, you just use moving averages that I've talked about. And after sector analysis, you look at individual stocks. And best is you put everything in the table. So you apply a simple moving average in a multiple time frame concept. So what is multiple time frame is you look at monthly chart, you look at weekly chart, and then you look at daily chart. So use a top-down approach. Look at bigger time frame, move lower down to a weekly chart, and then move one more level down, which is the daily chart. So in this example, I'm just going to show you two types of moving average, just 200 moving average, 50 moving average. Why 200 moving average is basically just to give you or to gauge a 1 year movement. 50 moving average is to give you roughly about 1 month or 2 months kind of movement. It's because again, we want to look at the momentum. And in terms of time frames, we're just going to focus on weekly time frame and the daily time frame. So best after that, when you have this tool ready in your chart, you create a table, you look at the sectors, you have the main index, STI index, then you drill down to mid cap, small cap, consumer staples, technology, and you slice it to weekly and daily. Weekly, you're just going to use a weekly time frame. Daily, you're going to use daily time frame. And from there, it's very binary, 1 is 0. 1 is 0 meaning is it bullish or bearish? So from there, you can do this exercise every single week on Sundays. So you slice it down, you look at in every sectors that you have that you like. Is it a weekly bullish or weekly bearish? Is it daily bullish or daily bearish? Let me just give you an example. So an example that I have, for example, like here, hold on, yeah, let me get my chart open. Okay, I have this chart open with me. Whoops. Let me move my screen to this one. Okay. Okay, so this is the screen. I'm looking at STX Straits Times Index. This is actually a refinitiv. Last time it was called Thomson Reuters. So under Straits Times Index, when I apply moving averages, I put just now 200 moving average as well as 50 moving average. And from there, let's look at weekly. This is weekly chart. You can see that STI is above 50 moving average. This is the closing as of Friday, and it is above 200 moving average. So what does this tell you with regard to STI on weekly? It's bullish. And then we move down to daily. So on daily chart, same scenario. You have the closing price above the 50 moving average, and the closing price is above 200 moving average. So it is bullish. So you do the same for other sectors that you like. For example, you want to see fledgling or maybe mid cap. So under mid cap, when you open up the chart, you can see that the Friday closing is above their moving averages on daily, and on weekly, it is also above their averages. So what does it tell you? These sectors, your main index, which is STI, is bullish, and you look down and just giving you an example of mid cap, it is also bullish. All right. So once you have that bullish charts, so what happened is you put back inside the table that you have, bullish or bearish, right? So you slice it down and fill up the table. That will be your every week kind of exercise before you start the day on Monday. And from there, you couple off with RRG. So this is another concept. We call it relative rotation graph. Okay, so what is RRG? RRG is basically a concept that apply relative strength in the technical analysis world. So it shows you the relative strength and momentum for a group of stocks. So analysis can be made to answer the questions which market will do better or worse, or which sector will do better or worse. And from there, you can see whether it can outperform the benchmark or the other competitive sector. So in RRG, there are 4 quadrants. You have the improving quadrant, leading quadrant, weakening quadrant, and lagging quadrant. So I run that RRG, the latest one, on Friday. Okay, from here you can see that there are 4 quadrants. This top right is the leading quadrant, bottom right is a weakening quadrant, bottom left is a lagging quadrant, and top left is an improving quadrant. So as an investor, if you want to go for a momentum play, all right, for a momentum play, you want to focus on leading quadrant because this has the huge or the biggest momentum, or you want to go for the improving quadrant. You don't want to touch anything or any sectors that is within the lagging quadrant because your money get stuck easily over there. So based on that analysis, we know that the leading quadrant in terms of sectors, we have energy, food produce, utilities. For improving, as of Friday, you have consumer staples, industrial, maritime, and telco. The lagging one, we have technology. So from there, and from that table that we constructed earlier, this is where, this as of Friday, I'm just putting some of them. Like for example, mid cap, we have bullish on weekly, bullish on daily, but based on RRG quadrant, it is from lagging and move to improving. So value-wise, it is still there. And when we look at, for example, small caps, so that's why we don't want to put your money in the small cap sectors, because on weekly, based on technical analysis, it is bearish. Daily also is pretty much bearish or sideways. How do we know it's bearish or sideways? Is when you look at the prices below the moving average, both moving averages, that's bearish. Sideways is when the price is actually in between the 2 moving average. So I call it as a sideways. So you will get your money stuck if you invest in this kind of sector. And then the RRG quadrant, where is it now? It's lagging, all right? It's lagging at the back here. Of course, it will improve, but when we talk about momentum play, that's why I said there's no right and wrong. It's just based on your own preference. If you want to have a quick win, I mean, a very short-term kind of holding, 1 month, 2 months max, or 1 quarter max, you go for momentum play. You want to find sectors that is under the leading or on the improving side. So from there, you can play the momentum and ride the momentum. So these are the sectors based on Friday last week. These are the sectors that is pretty much promising. Okay, from there, you slice it down, you put in the table. And even if you know how to automate this on your Excel, that even better. So for Refinitiv, just now, the platform that I show you, you can automate using Excel tools. So you can pull out all these numbers without you looking one by one. You can just do filtering, that's it. So once you have the sectors that you like, you look at the momentums, then you can choose stocks within that sector. For example, if talking about energy sectors, you have players like Capital. You have people. If you talk about banking sectors, you have people like UOB or OCBC. So you can choose the stocks from there. So let me show you again another slides. So from here, oops. So from here, this is Refinitiv. All right. So when you look at, say, Straits Times Index, right? You have the Straits Times Index. You can see the constituents, and the page is going to load and show you what are the constituents of Straits Times Index. Okay. Then you have all this, the top movers, and from there you can choose what kind of sectors they are in. So if you go back to the constituents, you click on constituent analysis. Like for example, we have oil and gas, we have Capital Corporation, and if you look at Capital Corporation, I type in here Capital Corp, and you can open the chart. You have the chart here. You can see the momentum is picking up. This is on weekly chart. of course, there's a bit of sell-off last week, but this on weekly chart, and if you look at daily chart, it's also pretty much bullish. So that's how, again, that's how you look at stocks, and that's how you construct your analysis, your portfolio. You look at the sectors, you apply technical analysis, and then for you to look at the index movement, which momentum has more, I would say, room to play, you lock it, you tag it nicely in your Excel spreadsheet. And from there, you can see which stocks are in each sectors. Like example, utilities also just now was one of the leading sectors. So under utilities, you have Sembcorp, right? So when you look at Sembcorp, and when you apply technical analysis, again, always look at the top-down approach. Look at weekly, it has rallied, and the strategy for moving averages, when the price dip into the moving average, that's where you buy, because moving average will act as a support or resistance. If the prices has been further out, very far away from the moving average, it is best for you to wait for a while, unless the movement is very big. So weekly, at least right now, it is still bullish. Of course, it meets some resistance here around $2.70. So there's a resistance. For me, I'll wait for it to retrace for me to buy again. Then when we look at daily, same structure. 270s is about the supply zone, which is the resistance. I'm just going to wait for it to dip further so that at least I'll try to write back the market. And it goes back to the scenario whereby people talk about energy market for 2022 and 2023, right? On top of Russia and Ukraine, that is a geopolitical risk. For me, we can put it aside, because geopolitics you cannot predict it easily. The leaders, the politicians, they can just pick up their phone and announce something, all right? So we cannot predict that. But if you look at the fundamental story about oil and gas industry or commodity, the shortages is real. When we talk about shortages, there's a lot of demand coming from developed countries and developing countries, but the supply isn't coming back in as what we have seen in the last crash. If you look at total rig count in the US, it is still below 2019 level. So the supply story is still there. And why there's a supply story is because of producers, especially in the US, they cannot produce more. They cannot produce as much as before because they have the ESG movement. So this is why I feel that that's the beauty of combining both fundamental and also technical. And fundamental here that I'm looking at is not the P&L of the company. I don't look at profit and revenue. I don't look at their gearing. I'm looking at the fundamental news, what's moving the market for the next 6 months to 1 year. Okay. All right. So let's go back to the screen. So once you have the sectors, you look at the stocks based on that sector. It helps you to filter out any other stocks, especially the high, if in Malaysia, we call it the goreng stocks. Goreng is like you fry it, right? It's speculative. People just simply, put the money in, punting the market, and, and then market rally by 5-10% out of no reason, no news, then people take out the money. So those are speculative stocks. Spec stocks, I won't touch at all because I love my money. I don't want to, imagine it's a real, you go out to the streets, you see some vendor selling items, you don't give money right to them, right? You don't. You have to make sure that the business is there, is established, and is being backed by the news, the fundamental, the government initiative, all right, based on the budget. That's the kind of business where you want to put your money in. So investing in stocks, investing in financial market, it is similar to how you want to invest in real life. You just don't want to just speculate and just put your money there, and next day the person just gone. All right. So as a recap, it is always best to understand the macro picture, followed by the main indices, and then look at the sector, and then look at the individual stock. So when you talk about major index, what is the major trend? What is a support and resistance? Is it downward? Is it bearish? Is it upward or bullish? Or is it just a sideways? And it is best for you not to just look at STI. Try to look at other major indices throughout the whole world. The main one would be the developed country. Because why? If the stock there is performing, money will come back in. Like, for example, those investors, they'll try to diversify because it gives you the term of risk on, risk off. So when S&P 500 is rallying, it's a risk on sentiment. As a portfolio manager, I feel like, hey, market is good. If S&P 500, which is pretty expensive in terms of valuation, if I buy today, maybe I can get about 5%. I'll look at other places like developing countries. It's a risk on anyway. If I put my money in the developing country, like Malaysia and Singapore right now, the borders are opened and the stock valuation is very, very low, it's cheap. If I put my money there, I can get more returns if I compared to I put my money in the US, right? So it is best to look at major indices. After that, look at the sector and then look at the individual stocks and just choose the best 3 to 4. And then most importantly, in choosing the right investment philosophy, again, you ask yourself, you want to hold your money, you have the appetite to hold your money longer, or you want to speculate and just in and out like an intraday player. So if you have a short to mid-term investor kind of attitude, you will write the momentum stocks, which is you're going to apply momentum strategy. You can look up in Google, momentum strategy using technical analysis. There's a lot of ways. Or if you are more into a long-term investors that believe that market is overreacting, you are actually a passive value investing strategy. So you find stocks that has a good technical, buy on dips, and you buy to get the good dividends and you ride for a longer period of time, which is 5 years or 10 years. Lately, of course, there's a lot of talks about quants, you've got algos, about model with a lot of factors. Those are the combination strategies. Bigger question is what suits your personality. So before I end today, so I have another 8 minutes left. The Refinitiv that I show you is actually a Thomson Reuters. Before this, it's not available to retailers, but now it's actually available to retailers via MetaStock. So for those of you who are interested, you can look at the 1 month trial. It's for free. You just use your QR scanner. You can scan the QR code here. You will get 1 month trial. Or for those of you who actually use it before and want to expand further your knowledge and then want to have it as a daily subscription or your monthly subscription, right now there's an offer of you for the price of 1, you get a 3-month subscription. So you can use your QR scanner to scan. And basically, if you don't have any QR scanner, you can type in the web address is Sequoia EK341 or Sequoia EK. Okay, I will open for any Q&A. Nonetheless, thank you for your passion and thank you so much for your time. Happy investing. You can contact me through Mata, Malaysian Association of Technical Analysts, through mata.secretariat@gmail.com or just my personal aiman.advisor@gmail.com. I have my mobile and you can find me on LinkedIn. Okay, Chris, back to you.
Thanks, Aiman. I enjoy your session very much. And come back to our questions. Our audience is asking where to find the relative rotation graph, RRG graph. Is it on the software that is sharing just now?
Right. It's actually based on Refinitiv. Actually, there are 3 avenues for you to use RRG. One is Refinitiv, the one that I shared to you earlier. Second is Bloomberg, but Bloomberg is, I have Bloomberg, so I use Bloomberg on my own as well, but it costs higher. It's about $1,005 per month. And lastly, it's Optima. So there are 3 software available right now that apply RRG.
All right. The next question is, do you see stagflation a possibility? If yes, then when will this occur?
Okay, short answer is yes. I'm seeing stagflation because you have a high inflation because of costs. Commodity prices getting higher and higher. As simple as we go to McD today, the price is getting higher and higher and you get a smaller fries, okay? So inflation is there and it's cost push because supply of the commodity side is actually having a big issue on the supply chain. And because of that, growth is hampering, growth is not there, all right? It will slow down. In terms of when will this happen, I think if you look at 2-year and 10-year treasury bond yield, you just look it up on Google, 2-10 inverted, that spreads has inverted, become negative territory. And based on my study, you can look up, I think in the internet also they have it. If that 2-10 has inverted, you have about 9 months to 12 months period, market will just going to react towards recession.
All right. And the next questions, do you expect Singapore and Malaysia will increase the interest rate also?
Mm-hmm.
All right.
They have to, because why? If the Fed is getting more and more aggressive, we don't want to have a situation like 1998. A lot of money flow out from ASEAN and move back to the US. Why people move out their money is because of they're getting a higher rate based on your investments. At the same time, it's lower risk in the US. Okay, so we don't want to have that because people will move their money because of the interest rate differential. So if the interest rate differential between the US, mainly the most developed and most safest country at the moment, if the differential is getting bigger and bigger versus countries in ASEAN, then you can have the outflow. So that's why the central banks in ASEAN region, they couldn't do that. They couldn't just, don't do anything. You still have to increase interest rates.
Right, the next question is actually on the charting part. For Ichimoku, do you agree that it is usually not able to buy at the bottom, as the trigger for buy happens seems only when the price moves above the cloud? And your comment on why some people still prefer to use Ichimoku?
Okay, I agree with you. In fact, in technical analysis, there are some tools that cannot really get, the sweet spot when you want to buy into the market or to sell in the market. You just could do that. But why people still use Ichimoku? Because, for example, it's a momentum play. For example, when you have the Chikao span, Chikao is one of the term in Ichimoku, crosses, people will go buy because momentum is bigger. Because the momentum, they measure how's the momentum today versus the momentum of X days before. Usually people use 14 days or 52 days before. So it's just purely a momentum play, but not purely as a buy and sell, because normally when it's a buy and sell, once the momentum kicks in, there's a buy signal in Ichimoku, price will start to retrace back before it continue the momentum. So best actually don't use only one. Best actually, if you ask me, you can go through the John Murphy book or any CMT book. They'll teach you a lot, and from there you use back all these tools and make sure it suits your own personality. For me myself, I use a few technical analysis style, but again, I've tried to become more passive as I age. I learn through experience. Things will be much smoother when you just look at weekly chart, then move to daily chart. Then you just hold it. But for momentum play, like people who want to play intraday, there's a lot of other ways. And risk reward for me, it's best for me just to take it easy. I've been trading for almost 15 years. So right now I learn like just take it easy. You don't have nothing to rush. It's a marathon. It's not a sprint.
All right. We have a questions on why do we have China index but not US on XGX?
Oh, I think that one we have to ask our counterparties from SGX to answer. I also not sure why. I also quite surprised there's a China index and also a China ETF in SGX.
Yeah. And the next question, how do you view Forex parity between Singapore dollar and Ringgit?
Oh, that's a very contentious question. Right now, to be honest, if you look at the last 5 years experience, how the market has performed, dollar ringgit, not dollar ringgit, Sing dollar ringgit has appreciated for them for the at least about average 2% a year. I think it goes back to the policy, it goes back to the environment of the local political scene and also the growth. So because right now in Malaysia, elections coming soon. So, and right now a lot of outflow from Malaysia, all because of politics and political stability and policy. So if things are more stable, then I think then we have a more stable Sing dollar ringgit. Actually, I just got back from Singapore last night. Yeah, so I know the exchange rates. It's like last time 3 years ago, because of COVID, it couldn't go anywhere. It's almost $3, 3 ringgit per $1. Now it's about 3 cents. So yeah.
Yep. I believe we answered many questions on the RRG chart on Refinitiv only. I think we have also in Bloomberg and also the Meta software, right?
Yep.
And another question is maybe this will be our last question for today's session. Which year in history shows stagflation so that we can check the corresponding stock market movement in those years?
That one, I think I need to check back. I can't remember. Right now, actually, my full time is actually I'm doing commodities. I'm a commodity trader right now. So right now, the concern is actually supply and demand. If you look at I mean, I don't answer your question right now on the stagflation, but you can try to look at 1980s scenarios. There's a lot of case study from there. To give you a pinpoint what year, I can't remember. I can't recall out of my head right now.
Okay, thanks Aiman for wonderful sharings, and thank you for your time. And that's actually thanks. Let's call it a day. And this is our fourth day full of information, analysis, and advice that you can take to the banks. And actually, if you would like to review of any of the session, the recording will be available until 10th of April at www.sgtradingfestival.com. And thank you for joining us. And here I'm wishing you a safe and profitable year ahead. And bye, everyone. Thanks, Aiman.
Thank you so much. Bye.
Thanks.